John, I've been gone. What are we talking about today?
We have too much to talk about today and not enough time. I like the wheat stuff. Kansas versus Chicago wheat, we're going to talk. We're going to talk wheat versus corn. We're going to talk about how cheap the bean calls and puts are, straddles, and corn. I mean, and wheat. Everything's cheap in the options, what to store, what not to store, and then we'll touch on cattle at the end.
And don't forget our American Federal Financial Minute.
Yes.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we skipped a whole week because you were out fishing, but I was just pulling up the grain prices to see what we missed, because basically it's been 2 weeks since we recorded, and beans are up 10, corn down 7, and wheat down 15 over the last 2 weeks. Not much going on price-wise, huh?
Yeah, it was a good reset. I was definitely out fishing for a week or over that. Obviously working a couple laptops, and you can work remotely. But I try to kind of not watch the markets as much and fish more. You guy needs a little reset. But now I'm back. There's actually quite a bit to talk about. What I like is that not much has changed. I didn't miss much, but going forward, it's going to be very interesting. So I have at least 6 different things I want to talk about today. And when you look at corn and beans, they aren't moving, and wheat slowly down. When you notice what's been happening is corn's been gaining on wheat, which means corn's too expensive. I know guys don't want to hear that, or wheat is way too cheap. But that's getting, I think it got in the 80s. And if you look at Kansas wheat, which is 13 cents under Chicago, Kansas is a higher quality wheat, higher protein, generally carries a premium to Chicago. When you look at the Kansas price versus corn, which is what's going to make it in the southern feedlots in the feed rations, we're in the 80s against corn. So that's unusual. What's normal for the wheat corn spread? 160. That's normal. So when you get to 80 cents, you're going to start making that into the feed rations. And corn domestically doesn't want to be giving up a lot of, room for wheat to be fed. But the way they have it priced, that's what's going to happen. Now, what's happening on the trade front is that our exports are excellent for corn. We don't get any more reports now.
Right.
You might not like it. Maybe it's a nice reprieve, but you're not going to see weekly exports. We have no idea if China's buying. Anybody can say anything right now, and there's no way to prove it or disprove it.
And the reason being the government's shut down. I just want to be clear.
Yeah, the government's shut down. So the reports will come when that happens or when it reopens. But until then, we're kind of flying in the dark. What we did see right before, and we haven't talked about, is they found 200 million bushels of corn. And normally I do chuckle at that, but we struggled through this last year. There's a reason why July went under December. There was a reason why there was all these deliveries in July corn, and there's a reason why the price crashed in February. There was way more corn out there than the USDA accounted for. It's almost always the opposite, where there's not near the amount that they say is out there. But last year, I 100% believe that this corn that they found is real. Because that's exactly what the spread said. That's exactly what the price said. That's what the delivery said.
That's what basis says.
That's what it started saying in February. It was at full carry in February between March and May. There was warning signs everywhere those USDA's numbers weren't wrong. So that's the bad news is we didn't have 1.3 last year. We had 1.5 that they've owned up to, and it's most likely going to be 1.7 at the end. Now, that's going to come out in the quarterlies. We just found 200 million bushels, probably taking that off in yield. So to argue about this is pretty fruitless. What I think is important is how do you market this particular grain market that we have? You're going to
stick your head in the sand, John.
That's what everybody's going to want to do. That's, I'm talking to a lot of guys. They're busy with harvest. They're going to put it in storage. Some guys are selling beans off the combine. Some guys aren't. Should I buy calls? Should I buy calls? These are all questions that we're answering on a daily basis now. But you're going to be defensive. You got to think your neighbor has what you have or more, and they're going to be looking for spots to sell it. So my advice to you is look for strategies that are defensive. Like if it rallies, here's what I'm doing, and have your goals modest because everybody needs to sell this crop. They're very undersold. Demand is not good enough in beans to sustain a bull market right now. Now that could change with the trade deal. It's arguable in corn. I don't think exports are going to pull corn up. Corn's trying to trade that right now, but I don't think it's going to be successful. Corn's expensive versus wheat. And there's a lot of headwinds here, even if technically we look good and all that good stuff. And look at all the bad news that corn shrugged off. It's got repeated bad reports and it's held in here. That's the good news. The bad news is we're at full carry. The basis stinks. We're at record-breaking carry in between November and July soybeans. What does all that mean? And we've talked about this. That's the part they can't hide. If you have record amounts of carry in the market, you're not going to have a bull market. It is going to be a very defensive market, meaning the commercial channels are full, rallies are going to get sold. Now, all the other bull markets, 2020, even last year, the spreads were on the move. We were getting inverted in the back end, and there was something going on, and we had a sustainable rally. We don't have any of that this year, so defense is going to be the name of the game. I do have strategies that do specialize in that, but it does not look good with the basis and the carry the way it is right now. And guys can spin it any way you want to make it seem like it's going to go higher, but that's the truth. We're stuck with a lot of grain right now.
Well, let's go over a couple ideas. I mean, let's start with, let's do a couple ideas for the grains. I mean,
Yep.
Soybeans, let's start there. That's where we're in the middle or end of harvest in a lot of spots. What are my options with beans right now?
Now, if you aren't storing, and a lot of guys don't like to store, they make room for corn, and it's just a pain to store beans. Either you can haul them in town and pay 5 cents, or you can own a call for about 38 cents, into March. So you're going to pay more for a call this year than you would for storage. So if it's going to be right around 6 months that you're going to store it, you're going to pay 30 cents for that, and you're going to pay 38 cents for the call. So it's about 8 cents more expensive, but you don't have any of the downside risk in a call. Like you can own it, or if you sold it, you can re-own it via a call. That's an option. Guys are thinking about it. What I don't like is there's a massive amount of carry in the bean market. So you're not at 9.19 or 10.19 in the front. You're at 10.50 in March. So that's one way to do it. Soybeans are going to be an interesting market. We planted 81 million acres. If we cannot rally this year, we're in serious trouble in soybeans. This is the least amount of acres that we're going to plant in the United States. And if we cannot rally, it's going to be devastating for the soybean farmer. So I hold hope that things do change. We get a trade deal. China starts buying, if they're not already buying, and we have a much better market.
But so that's one option, owning a call. There's got to be other things we can do.
Well, I like the July, November beans, but I don't like it with China not being in here. I think that you're going to have two different markets, but that's at 10 cents above. I don't know if it's going to make it to zero. It very rarely does. I really like that. But you do not want to take extra risk in this market. We don't know what any of these trade deals are going to happen, not happen. You want to keep the risk low. Do you store soybeans or do you not is a simpler way to do it. If there's, again, we planted 81 million acres. If you're going to take a chance in storing soybeans, it's this year. I meant we're going to plant more than this every year. And we always have, unless the weather, says that we can't. That happened in 2019. Other than that, this is going to be as low as the acreage goes. So yes, I mean, you would have to, this is a year to take a chance on, because if it can't rally this year, it's not going to rally very easy at all, from here on out with a lot more acreage until at least we get some policy change or something going on there. So yes, this would be definitely categorized as a year where you would want to at least re-own the beans via a call if it fits your risk parameters, or you'd want to store it to see if you're going to get a better price.
But the reality is the market's saying there's no sign of good things at all. The basis is saying that, the spreads are saying that, the
everything's saying that. And you can ignore it, and people do every year, but that's the market saying we have too much in the commercial channels. Please store your beans. We don't want it up front. And that is the reality. That's not uncommon at this time of year, but we did see November run against January last year. There were signs of life there. They were taking carry out. It wasn't even as bad as it is this year. This year, we're not past the harvest pressure yet. We'll get a better feel right after that. So don't think that it can't rally. That can improve very quickly in soybeans, and that's what we're going to be looking for. That'll be the cue for us to be putting on positions here, whether we're going to be doing option spreads, the July, November. That's what we're looking for as basis improvement, better news.
What about straddles? I mean, are straddles an option in beans, or are the prices is there too much premium in beans right now? What's the story?
Okay,
there?
so straddles is buying an at the money call and at the money put. And this is a volatility trade, meaning you're expecting the implied volatility to go up, and thus you're going to profit. It doesn't matter what direction it goes at all. That's why this is an interesting strategy, and I talk about it, and guys really like it. So when do you buy straddles? And the strangle is going to be different strike prices away from the money. So that's the difference between those. So let's talk just straddles and beans. It was 74 cents for 10.50 on the put and call side.
In what month?
In March.
In March, okay.
So what the trade is saying is, and that's probably 14% of implied volatility, which is really historically very low, meaning options are very, 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 very cheap. So they're betting that the guys selling those, that beans aren't going to move outside of 74 cents up or down. And they're also betting that there isn't going to be some news that makes implied volatility go up. So we could be at the same price, but if it looks like a trade deal is likely to go through and we're not really going higher in price, the option premiums can go up and you can profit that way, just a change in perception. So 74 cents, and that has all the South American weather in it. That's very cheap. You own the put, you own the call. And just for easy math, just say they're 36, 37 cents each. They're not. One's a little more expensive than the other. So the bet is that it moves more than 74 cents in between now and the third week in February when you buy that straddle. Corn is unbelievably cheap. You're looking at $4.35 for 21.5 cents for corn. So you own the put and the call.
The straddles 21?
That's, if I'm not mistaken, it's 21.5 cents, 14% implied volatility. Very, very low. The highest volatility in grains is 18% in wheat, which is really low for wheat too. Options are cheap. You can buy a straddle in corn. $4.35 is the strike price for 21.5 cents, if I'm not mistaken. So what the trade is saying there is corn's not going to move more than 21 cents. Basically all the way into the third week in February, up or down. It doesn't matter what direction it is because you got to put, long call. So they're saying it's not going to move 21%. Now, that's getting so low that it's getting tempting to own that.
I just double checked you. It's 31 cents.
31. Okay, I did write that down.
31 cents.
It did.
But
seem
still,
low.
31 cents.
31 cents is the range that they say it's not going to move more than 31 cents total up or down in between now and March. So you can tell how cheap all this stuff is. So what do we do with all this? Well, depending on what you need to store, what you can't store, you would talk to guys like us and we would go through these kinds of things with you. Like if you don't want to pay 5 cents of storage in corn, how much is a call right now in March? Let's do the math right now.
Yeah, well, the 35 call trade at 16.5 today.
Okay, and how many months is that roughly? We're looking at 5.5 months, I think, right?
Yeah, 136
I think it's 5 months.
Days.
So 35 cents, you're going to pay you're going to pay 25 cents in storage at the very minimum to store it into March, right?
Yep.
And if you buy a call, it's going to cost you said 15,
16 and a half.
16 and a half. So you're going to pay less just simply buying a corn call than you would paying 5 cents a month in storage. Very easy math there. The call is cheaper to own. It's 5,000 bushels of corn at the money. If you store it, you're looking to capture that carry if it stays up here. But if corn were to come down, you can lose your option premium, only the 16 cents you pay, but you can't lose any more than that. You can lose a lot more storing corn in the springtime than 16 cents. So that's what the preferred deal is there, that you'd want less risk. Now, what's the downside of that? Basis. If basis improves, you can make it up there. Now, is that likely to happen in our area? Not really.
I mean, there's a balance there, though, right? Like, if the corn price is going up, basis is also going to improve. Generally.
Not necessarily when you got a crop this size. When
That's true.
99 million acres, you might not see that this year. But yeah, in general, that is true.
Yeah. I mean, it's one of the signs we would look for to see if we feel like the price is going to improve is basis improving first.
Basis gives it away almost every time. Very rarely do the futures move. Then the basis really strengthens up a ton. Every once in a while that does happen. Yeah. And that tends to be in lower, like the trade will anticipate, let's say we had 1.2 billion bushel carryover. Harvest pressure is here. The trade might anticipate basis tightening up and start moving futures early. But with 2.1 or whatever we have on the books, 2.3, doesn't even matter. That's a very unlikely scenario. But in case it isn't out there, which is what everybody's going to say, that is a bull, that it's not out there. The basis is going to tell you the truth. I've said this. The spreads will tell you the truth. You don't have to believe anybody. Watch that. If that doesn't get better, that you're very unlikely to see a large rally. Very unlikely.
Yeah.
And that's just the reality that we have right now. So we found 200 million bushels of corn. So even if they take it off 4 or 5 bushels, it's going to stay the same number, which is likely. I mean, I think that's likely. So what you're looking for is strategies in these types of markets. And that's where we would come in and tell you exactly what we're going to do. I have a great new crop strategy that I'm working with. I haven't done it yet, but I most likely will have it on by the end of October. That'll hopefully alleviate a lot of problems for next year in marketing. I also have some old crop stuff. Call us and we'll go over these ideas with you, but you're going to need ideas in these markets. These are not good. Sitting on 5 cents a month in storage and hoping is not the best strategy in the world. Although I'll say it's not like there's all kinds of things to do and you're missing out on everything. It's just things do change fast and you need to be ready for that. And that's going to be the difference between guys that market well this year and guys that don't. What I see happening is us coming up, everybody calling, should I market? Should I market? They're going to want 5 or 6 more cents. And then all their neighbors will take that and then it'll collapse. So this over and over, up and down, I think is a very likely scenario unless there's a trade deal, which really, kind of ties everybody's hands. Like that could happen. And if it were to happen, then all of a sudden you have a different market. Beans could pull up corn and it could be a much, much better market. But where I would concentrate is the levels I want to sell old crop. And do I want to re-own it? Do I want to have courage calls on? Do I feel like it's that kind of market? Options are very cheap. So this is the time of year to start planning for stuff you can't store, stuff you don't want to store, and that sort of thing. So that's mainly what all the phone calls are this time of year.
Absolutely. Well, do you want to shift gears a little bit? Let's dive into, I'm going to go off here, away from your notes for a minute, but let's do the American Financial Minute. American National.
Stock market goes up every day.
Yeah.
Yeah. So
market. Well, it's red right now, John.
So this ties in with interest rates and banks. It's like mortgage rates have come off a little bit, then they went up, then they went down, but mainly that's stabilized. They're not skyrocketing anymore. So when you look at, the banking outlook, the economy outlook, right now you have a very positive stock market. People feel like they have money if they're in the stock market and their 401ks are doing well. So we're lowering rates. The question is, how many more times are we going to do it this year? The market's, I think, trading 70%. There's going to be 2 more cuts this year. It's likely to be 1 more cut, probably not 2, and the market maybe even be it's probably trading that by now. So you're not seeing a great deal of volatility. You have an administration that's claiming inflation's under control, but I think anybody living in life doesn't feel like it's in total control. You have gold up near $4,000, near all-time high. Silver is climbing. You definitely have a lot of warning signs. Inflation isn't under control. So for right now, you just have a slow, steady declining rate market. And as long as the stock market goes up every day, everybody feels wealthy that's in the stock market. And they're going to continue to spend money. But I think that one bump in the road especially with this jobs market and the way that inflation is, that it quickly could come undone very quickly. The argument is they're not lowering rates fast enough to get ahead of this. And the other argument is inflation's still roaring. You can't cut rates. Oil doesn't do anything.
No, it's just sad.
So that's not a good gauge on the economy either. It's stuck at 60 or 61 bucks. OPEC's going to pump a little more oil. So there's really nothing to lead us to believe that rates are going to go up or down a lot anytime soon. And the economic outlook's great depending on who you believe, but the jobs look like they're softening up, and inflation looks like it's still fully out there. So kind of a mixed bag. Guys have been calling and they've been interested in shorting. The micro Dows have been talked about. The S&P 500 and the NASDAQ 100 also available. So guys are leaning on the short side still, but really, honestly, all you have to do is buy every day up. Seems to go up every day.
Should have been doing it the last 5 years or so.
The last 10 years. I mean, they say there's been a couple large corrections, COVID and something else. And you're talking like 3 weeks max correction.
Yep.
We haven't had a large correction since 2008. And when this thing does come, it's going to be a monster, and it's probably not going to be good.
And let me know when it's coming.
Yeah. So the long side of equities has been the play. Feels like a bubble. It's felt like a bubble forever. What else is there to really say about it?
Yeah, absolutely. Well, if you don't want to say anything more than about that, let's talk about cattle, the other thing that only goes up.
Very different market, very unique market. One thing I wanted to get in, there was the Kansas versus Chicago spread is a spread that we're watching. Kansas wheat's 13 cents under Chicago in March. And that's a spread that we are watching, and we will hopefully be looking for an entry point depending on a lot of different things, fundamentals. Argentina just popped up and made me not want to buy it because if they're going to sell a bunch of wheat on the world market. But I do like the higher quality wheats when they get under the lesser quality wheat. So that's a spread I'm really keeping my eye on. But back to cattle really quick. We have a premium to cash. Basis is negative in live cattle. That has not happened in a very, very long time. So what is happening there? The feeder cattle market. The feeder cattle market says, wait a minute, live cattle. Just because box beef's plummeting, just because cash is coming off $6, $7, $8, $9, doesn't mean that we're not in a roaring bull market. So all the actions at the feeder barn, these guys are paying up. Nothing's stopping them. You talk to these guys buying cattle. It's worked every time they've done it. They're going to continue to do it. Feeders are driving this. Now, the better question is, should the feeders be driving this? No, the math doesn't work. Yes, there's going to be cheap feed out there, but if you look at hedging profits in when buying feeders here, you're going to be out of luck. That's not going to be possible. So what do you have? You have nothing but market exposure here. I don't like how we're carrying a premium in live cattle, and then they're buying the deferred saying, hey, this bull market's never going to end. But they open that Mexican border and it's over for feeder cattle, at least temporarily. The Brazilian talks are going okay. They had that. So if that opens, that's going to be a big deal for U.S. beef being imported from Brazil, Brazilian beef being imported into the U.S. So it's I would say, a fundamentally very shaky market up here. It's built on hopes and dreams, this one. The good times were rolling. If you bought cattle, you made money. They want to keep the good times rolling, and that's exactly what the futures are doing. They're following the sale barn.
I will say I have lost some money this fall trying to short it. So
yeah, that's the thing. It's still a well intact bull market, but this is structured very different. This is not like the way up where futures were chasing cash, constantly discounted, cash walking up. We're coming down in cash, coming down in box beef, seasonally going into a year where it's a time of year where it's soft. And the feeders don't want to hear anything about it. The feeder versus fats, feeder versus finished cattle spread is at record highs right now by a long ways, meaning they're as expensive as they've ever been relative to live cattle. And this is going to end terribly one day. I don't know what level it is, but this is a real unsustainable thing that we got going on. You're going to need to see cash and product come back up to sustain this. Otherwise, we're going to be in big trouble here. So I am actively talking with guys about hedges. I won't say specifically what we're doing. Everybody's doing different things, whatever fits them. But talk about a market that's a very hedgeable board, and it looks very good in live cattle right now.
Yeah, very interesting. That's different than it's been.
Completely different look to the cattle market right now. Yes.
Perfect. Well, anything else you want to add today, John?
No, we talked about how cheap the options are. It's a time of year where, planning is important. What you keep, what you don't keep, what you cover, what if you keep it, are you covering, for downside? It doesn't feel like that. There's a lot of different things, a lot of different questions, but these decisions right now can have a huge impact on, what you have going on in the spring. But I'm already focusing on new crop. I think that you're going to get a chance at a good price, but I want to make sure I have my upside wide open for summer. So this is definitely a time of year to plan, and it's going to be a struggle. There's no doubt these aren't good markets, but I wouldn't give up. Guys that don't give up tend to do a lot better than guys that sit there and hope. So I would play defense this year and keep your mind open for good ideas and try to sift through those and pick out what's best suited for your farm, your operation, and concentrate on that, making the price work. And hopefully we get some good news here on this trade deal, but I don't know. I don't know how long these markets can keep on saying that trade deal is coming and hang in here. You know what I mean?
Can you get a trade deal when the government's closed?
Yeah, I suppose. Who knows? I mean, who knows when it's going to open? That is a mess, that side of stuff. But I think that we could, if anybody could do it. These guys could do it. So I still am very worried. They're going to send out $10 billion in payments. That didn't sound like a vote of confidence that there's right around the corner. This is going to be fixed. This seems lengthy, and we won't even get into that debate. I mean, it's endless on Twitter. You go ahead and get in the middle of that on there. It hasn't worked in the past. I don't think it's going to work very well this time. I can't see inputs going down if everybody gets paid. But that's a whole nother story. We won't even go down that path.
No, I mean, the sad thing is, like, inflation in general, to have any price reset, like, we have a new floor basically, right? So to have any sort of price, well, not just the grains, I mean, anything, cars, food,
it looks like
grains, across the board, it seems like we have a new floor. So that's where I look at, like, from an inflation level, is there more inflation, or is this just the new floor? It's going to sit here at these prices. Like, what would it take to actually make prices come down from where they're at? That's a little scary.
A 2008, that is going to be the problem when the correction comes, because they're not doing it in a healthy way where, politically you can't have a down economy. So it's always got to be up. And this is going to come at a cost. These guys continually supporting it through subsidies, not just in agriculture and everything. I mean, everything's dependent on the government continuing to throw money at all this stuff, and then the stock market going up every day. So when it doesn't happen, that's when the real pain comes, and everything's built on this functioning this way. And this is not the way markets function, continually up every day. It's going to come at a heavy, heavy cost. And I think it's probably going to make 2008 look like a walk in the park. And that's when prices would come down. And those are the cycles you do see, no matter what, the boom and bust. Highly inflationary cycles, the rich get richer and the poor get poorer. And then what happens, though, the rich do get hurt when the stuff busts, but the smart guys are in there snatching up everything when it's cheap. And we are cyclically very due for something like that to happen. You're starting to see land prices definitely ease up in farming. Not in all areas, but this area for sure you're seeing that. Yeah.
That's why I don't have any money, John. I'm
saving up for farmland.
I'm saving up to buy stuff when it gets cheap, because with all my non-money.
Yeah, that's what I've been thinking for the last decade, and I've been wrong. I mean, it's just like it just is carried on a lot longer than one would have thought it could. But when it comes, it's likely to be very bad. I mean, you have to look at. We both have kids. These kids don't even know that there can be a downturn in anything. They my oldest daughter's 22, and then my youngest is my son. He's 17, and they don't even know there can be down markets. They've never even seen that.
I'm going to dispute that just a little, only because my son's been talking a lot about this. He's 19.
Yes.
And he's been talking about how important it is for his generation to have economic reset. because they can't afford to invest in this stuff. They can't afford to buy a house. They can't afford to buy.
Yeah, that's when you know things are bad. Where you actively have people cheering for it in that age group because they can't afford any of it. And I agree. Like the cars, just look at a used car. Right. Something is going to give here pretty soon, and it is probably going to take max pain. And they feel like they have nothing to lose because they can't get anything.
Yep.
That's not a healthy structure where they're cheering for a big fall. You know, that's the best case scenario. Otherwise, have the government help them. You know what I mean? And that's really the position these kids are in, and it's too bad. When we were growing up, man, you got a friend or two together and you get apartment for $700 pretty much anywhere.
Yep.
Like that's not going to happen anymore. You could take $2,500 and go get a car that's going to run, you know, probably 75,000 miles on it. That would have been high mileage back then.
Right.
And $2,500, you're walking off the lot with something decent. Those days are long gone. Now you're paying, $12,000 for 125,000 miles, and that's a deal.
Yep.
You know, a not very good car.
I mean, I have a friend moving out to Bend, Oregon now. Granted, Bend has never been a cheap place to live.
No, I've been there.
But he makes a very fair, let's call it a very fair living already.
Yep.
He is choosing to work at a resort for the housing.
Yeah.
Because even though he makes a fair living with his day job, it's going to be way cheaper to do the employee thing and still do his day job.
Yeah, no, it's just the reality that we live in, and be it Airbnb has changed everything or whatever. It isn't like when we were growing up. So something will reset this, and most likely because it's taken so long, it'll be a lot worse than it should have been. I still think going back to 2008, what they've did is basically the government backed everything up.
Yep.
Didn't let anything fail, and it's never corrected. So when it finally does come, either hyperinflation or, whatever bump in the road that's coming that unravels everything, it's always something different. That it's going to be a bad one this time. Maybe we won't be alive. I mean, we might not be.
Right.
Most likely we're going to be. But that I still believe that is coming.
Most likely for us, it will be right at our retirement age.
I don't know if that's going to be bad. It'll cheapen up stuff, and you get a little condo in Florida and go hang out in the fishing pier every day.
Love it. Love it. Well, that was a bright, happy way to end the episode, John.
Yeah.
Why don't you leave your number here?
Yeah, actually, we had a lot of stuff that we were going over today. So if you want more details on any of it, give me a call at 218-731-1578.
Thanks, John.
Yep.